Hello and welcome to Fidelity Connects. I'm Pamela Ritchie. With trade deal announcements in full swing, global business leaders are poring over whatever details can be found to show the emerging architecture of America's new trade connections. This week looks to major central banks as well in Canada and the US for decisions about whether to cut or hold interest rates, and for commentary from the BOC and the Fed on how to thread the needle between overly restrictive and fighting future inflation. For the economies of these two neighbors, it is a tale of two very different cities. So we will hear in the commentary how that stacks up. Joining us today to help set some of these moving parts into an investment thesis while explaining the more evident fiscal dominance in markets is becoming is Fidelity Director of Global Macro, Jurrien Timmer. Welcome, Jurrien. Great to see you.
Good morning, Pamela.
Delighted to have some time with you here today. Okay, so let's begin with the trade deals. The EU has signed this deal. There's immediate pushback from business leaders saying, oh my goodness, you negotiated our rights away. That said, they've come a long way. Where does this land?
Yeah, I think the market's overall sense is a little bit of relief that, if we dial the clock back to early April and Liberation Day and all these crazy tariff amounts that were these reciprocal tariff amounts to then, giving a pause and sort of, a calming down period where negotiations could take place. And now with negotiations taking place and the numbers, obviously they're tariffs, they're an import tax, someone has to pay for it. And I think it's generally the importing company and also the consumer. So it is not a good thing in terms of, someone has to pay for these things. But I think there's generally a relief that maybe that whole wave of all those announcements and punitive actions are that wave is cresting, that there's a Japan deal. Now there's going to be an EU deal. I'm sure there'll be a Canada deal. And that at least, we're kind of ticking the boxes. And obviously, no one's going to like all the terms for all the events. But when you have that cresting wave, while a new wave is sort of forming in terms of the big beautiful bill, it lifts earnings, right? So the tariffs are generally not perceived to be bad enough to really kill the earnings engine, at least in the U.S. And now we get another wave that should boost earnings as well as capital spending from the big beautiful bill. And as a result, we're seeing earnings season now for the second quarter, coming in very, very strong. Of course, it's still early days, of course, in terms of where the tariff cookie will crumble. But I think that's generally what is supporting the markets. And on top of that, you've got a fairly ample liquidity environment in terms of global money the global money supply. Animal spirits are returning. People are buying the meme stocks again. That was so 2021. But so I think generally the market is optimistic that you've got another big fiscal impulse coming within the U.S. And of course, you're seeing this repeated elsewhere, including Canada and Germany and other parts of the world. While the worst case scenario of a trade war leading to a capital war is sort of been moved to the side. And I think that's generally what the vibe is like in the markets here.
So it's interesting. I don't want to jump too far ahead because there's lots of pieces in between. But if you look on some of the trade calming to an extent, I'm glad to hear you think Canada will have a deal too. That's very nice to hear. In any case, is growth are we looking at a growth market, I guess, is sort of the question. And is its aim to kind of grow out of debt, which has been front and center, of course, for Scott Bessent and the entire administration, is to try and grow your way out?
Yes, I think there's generally a recognition in Washington amongst policymakers, but also in the markets now, that really nothing stops the train in terms of deficit spending. This is a worldwide problem, of course. Yeah. You have aging populations, lots of entitlement programs around the world, pensions that have to be paid, and you don't have generally enough organic growth through rising birth rates and things like that to just be able to maintain that status quo. And so then the alternatives are, obviously default will be one, but nobody's going to do that. austerity would be one. That's what Greece did during the sovereign debt crisis, but and that's what Argentina, of course, has done. But that's generally a very unpopular action, and it obviously curtails growth in a pretty big way, and it's generally politically suicide. So really, I think what the policymakers in Washington, led by Scott Bessent, are hanging their hat on is that, okay, we're not going to be able to cut the deficit, so we got to outgrow it. Right. And I think the big beautiful bill is part of that, and we'll talk about this in a bit. But keeping monetary policy accommodative enough to help pay those bills is another part. But I think that's what they're kind of focused in. They're all in. They're not going to be able to cut the debt or cut the deficit, so let's grow our way out of it. And generally speaking, that has, it could happen, right? It's hard to have lots of growth like we did, for instance, after World War II, because we had a whole baby boom of new people to come into the economy and increase GDP. Right now, we have an immigration policy that's obviously not the friendliest, so it's not going to come from a growing population, especially with the aging population that's already in place. There's a hope that the AI boom is going to create that productivity lift that in turn will increase the speed limit, if you will, for the economy. And again, the math, the very simple back of the envelope math is as long as GDP growth, nominal GDP growth, is higher than the 10-year yield, the cost of borrowing, basically, the debt is considered sustainable. And right now, that's been the case, and it has been the case for some time. The 10 years at 4.5-ish. The 5-year growth rate in nominal GDP or nominal potential GDP is around 5.5. So it's sustainable right now. But if the bond vigilantes ever were to cry foul and say, you know what, we're going to push yields up to 5 or 6%, and that growth rate would happen to falter to 4%, then of course it's a problem. And so that can be mitigated in one of two ways. One is if you get that productivity boom from AI, you can lift that non-inflationary speed limit. And two, if you somehow find a way to keep the 10-year yield or funding rates down, that's another way of doing it. And that gets you into the whole financial repression conversation that we've, of course, talked about extensively during COVID and other times. But there's only a couple of levers there. And maybe only one has to be pulled, maybe both have to be pulled. But that's kind of where this train is going. And I think that now that the tariff question is kind of getting some answers, even if the answers don't please everyone, I think that's really going to be the next big story in the markets in the coming year plus, especially with Jay Powell at the Fed, retiring, at least from the chairmanship role next year.
And of course, this week there is a Fed decision, and there's been great pressure, we know, about the entire story on Jay Powell to cut rates. Should we begin with what's happening in 2 days and then sort of extend to the story of what that might look like a post-Powell Fed eventually at some point? Any chance he's going to cut rates this week? He said no, basically.
It's not expected. And again, there is still the sense, even though it's not completely visible yet, where the inflation is coming from. Even the Bureau of Labor Statistics, I think those are the ones measuring inflation, they're not even really staffed enough after the Doge cuts to even have a sense of where prices are at. But that's a whole other conversation. But basically, when you look at the Taylor rule, right, which is a rules-based algorithm of where the Fed should be, it's a neutral rate plus an inflation component plus a growth component. It suggests that the Fed should be exactly where it is. It should be a hair above neutral, and neutral is probably 3.5 to 4. Fed's at 4 3/8. The unemployment rate at 4.1 is below kind of what's considered the sustainable full employment rate of which we used to call neighbours. That's about 4.3. The inflation rate at about 2.7 has been very sticky there, and that's above the Fed's target at 2. So under no circumstances, as far as I can tell, would the Fed be justified to cut rates into the accommodative zone, which would be, let's say, below 3.5. I mean, that you would have to be in a recession, and we're far from that. So that's certainly not justified. The Fed is justified to cut once, maybe twice, and maybe it'll do that in order to appease the couple of people on the Fed who are very blatantly lobbying for the role of the next chair. I won't mention any names, but there is a risk that if the Fed holds policy steady this week, which is the expectation, that you could get some dissensions. And that's not the first time that's ever happened. It's not that big a deal. But again, there's a couple of people on the Fed who want the next job and who are making it in very Trump-like fashion, making it very obvious with their speeches that they are willing to go along with sort of the game plan in Washington. And so maybe the circus starts this week, and it's only going to get worse because Powell's term ends next year, May, I believe. He may or may not stay on at the Fed as governor. His overall term doesn't end until 2028, but his chairmanship term ends in 26. And then you get into the whole notion of, okay, will a de facto successor be named, whether it's Waller or one of the other folks? Is that person from within the Fed, from outside the Fed? If it's from outside the Fed, there has to be a vacancy at the Fed to do that. So Trump might be limited in where he can kind of fish from. But let's say it's someone within the Fed, then you're going to have issues where that person starts making proclamations of what he or she would do after Powell leaves. Right. And, that can get kind of chaotic, right? Because then it's like you don't really know who to believe anymore. And so it weaves into the larger picture of what we call fiscal dominance, where clearly the administration is moving along with fiscal expansion in order to pump up this engine, this economic engine, to grow out of debt. I mean, they are very conscious about the debt. They want to reduce the debt, at least relative to GDP, which is how we generally look at it. So I think in that sense, they have the right idea in terms of, okay, you don't want to get stuck in a debt spiral. Nobody likes that. So you have to grow your way out, and maybe AI is the ticket. But if it's not, you'll have to keep rates low enough that you can actually fund, fuel this debt while growing out of it. And it gets you into the 40s, into the Japan financial repression era that is sort of not quite ending, but sort of ending, or even the late 60s. And then you get into a much bigger can of worms or kettle of fish in terms of, okay, if that happens, what is the price that we have to pay for that? Is it higher inflation? If rates are artificially low, is it a weaker currency? And again, we have some charts here, so we can go into that. But that, I think, for me, this is the next chapter or iteration of big picture stuff that we need to think about.
Well, let's ask you to bring some of those charts up. One piece of this, and I wonder if you could do a little bit of a primer on us. In fact, if rates fall and therefore there's some stimulus essentially released into the economy, the long-term yields, the duration yield story will probably fire straight up, and then they introduce yield curve control, which often doesn't sound like what you'd hear about in the United States. You hear about that in other countries. Remind us of what it means and what would have to happen to bring that in.
So let's go to slide 9, sorry. Yeah, so let's unpack this a little bit. So obviously, this is the fact that is staring us in the face. And this is not just in the US, right? I mean, this is the US in this chart, but this is happening everywhere in the world, or at least in developed nations, Canada, UK, continental Europe, Japan, China. So this is not a unique story to the US. It's a story about global population, stagnation, if you will, at least in the developed world. So the increase in debt since COVID is 13 trillion. In the early years, the Fed was sort of mopping that up during, again, the QE days during COVID and following COVID. And then it overstayed its welcome. It was too accommodative in 21. We got basically a little asset bubble. We got obviously the inflation, the COVID inflation, and then the Fed reined in, raised rates dramatically, as did other central banks, and then started to shrink its balance sheet. So from that point on, the debt kept going up, and it's really going to go up now because we have the second $5 trillion fiscal impulse now in 5 years. But the Fed's holdings are going down. So that means there are really no longer any uneconomic buyers. And by that, I mean buyers who are price insensitive because central banks are basically not in the QE business anymore.
Hello, investors. We'll be back to the show in just a moment. I wanted to share that here at Fidelity, we value your opinion. Please take a few minutes to help us shape the future of Fidelity Connect's podcasts. Complete our listener survey by visiting fidelity.ca/survey, and you could win one of our branded tumblers. Periodic draws ending by March 30th, 2026. And don't forget to listen to Fidelity Connects, The Upside, and French Dialogue Fidelity podcasts, available on Apple, Spotify, YouTube, or wherever else you get your podcasts. Now back to today's show.
So the question is, who's going to buy this debt?
The treasuries,
like
who's going to buy
right?
treasuries?
So, yes. And so if we then go to slide 11, that brings us to the Fed, of course, and we know the drama of Trump calling Powell names. It's very unfortunate to hear all that because I think Powell generally has done a good job, and he's an upstanding citizen that is trying to manage the Fed in a independent way, which is exactly what it should be doing. But so the Fed has cut 100 basis points last year. It can certainly cut a couple more times until it gets to neutral. And so there is some room. The economy clearly is not clamoring for it, and that's why I think he is rightfully holding on to that dry powder. But he could cut a couple times and then be closer to neutral. But that's probably not going to stop the president from abusing him. But so the question then is, and if we go to slide 12. If the Fed were to cut more than is deemed justified on the basis of the Taylor rule, of its dual mandate of price stability and full employment, I don't think Powell would do that, but his successor might, right? Let's say you have a blatant, political hack in the Fed, and he cuts rates to 3% when there's absolutely no justification to do it. Well, there's no free lunch, right? So at that point, the yield curve presumably would bear steepen, meaning the shape of the curve goes up because long rates are rising while short rates are falling. And then the term premium would rise. It's already at about 80 basis points. It could go to 150. And then all of a sudden, you got short rates at 3 and long rates at 5.5. That's not going to help anyone, right? The government could fund all of its debt at the T-bill rate, but people with mortgages and other long-term borrowers, would obviously be left holding the bag. So in my sense, if the Fed were to make political rate cuts rather than economically justified rate cuts, it would have to almost immediately then do yield curve control, which is what the Bank of Japan has done over the years since 2013, what the Fed did back in the 1940s, and that basically is you're manipulating the curve so that long rates stay low. So you anchor short rates at a low point. Maybe you regulate the banks in such a way that you're sort of incentivizing or forcing them through reserve requirements to buy long paper. And so in order to keep rates down. And of course, as I just said, the Bank of Japan has done that. If we go to slide 14, you can see that the BOJ, of course, has a massive amount of debt, far, far greater than the US, although the US certainly is catching up. And back in the 2010s, the funding cost of Japan's debt as a percent of GDP rose to about 4.5%. And I think that was sort of the line in the sand. I wasn't there, so I don't know. But at that point, they started to do yield curve control. They basically capped long rates. The Bank of Japan basically bought every JGB that it had to. It ended up owning and buying about half the JGBs outstanding. And that basically removed the Japanese bond market from as an asset class that investors would buy for economic reasons or because yields were attractive, and it just became kind of this own thing. And the U.S. did the same thing in the 1940s. And so at this point, the Bank of Japan has been able to keep their funding costs pretty much level at about 4.5%. The U.S. is now at 3.6, so you're getting into that zone. And so, would this be an option for the Fed if it was not quite as independent as it is now? It's not inconceivable. I mean, it sounds weird to even be talking about these things, but if we go to slide 16, you look at the debt service in the U.S., and it's 1.2 trillion out of a $7+ trillion budget. It's a meaningful number, and it crowds out other spending programs, whether it's defense or entitlements or what have you. And then again, unless you cut spending, you just have to keep issuing deficits in order to keep paying for that debt. And that can become a debt spiral that if that funding rate goes up a lot relative to the economic growth, you can get into kind of a classic emerging market like debt spiral. And so nobody wants to go there, of course. But so again, I don't know what's going to happen. Maybe none of this will be necessary. But if the Fed were to drop rates kind of beyond what is justified by the rules-based system, only to help the Treasury borrow from the public or issue debt, it will also have to manage the back end of the yield curve. Otherwise, the curve would just steepen tremendously, and it wouldn't solve any problems. And again, when you think about that scenario, there's no free lunch, right? Something has to give. And if we go back to the Japan scenario on 15, you can see exactly where it was that the Bank of Japan started to do its financial repression. It was around 2013, and its assets relative to GDP went from 25% to 132%. The Nikkei went up, it's at an all-time high, so the stock market can do very, very well in this scenario.
This is a big question.
Yeah, because you have a very fiscally and monetarily stimulative backdrop. So maybe this is why the meme stocks are already running, right? This could be a melt-up type situation, but look at the yen, right? The currency had to pay the price for this, and my sense is that the dollar would have to do the same in this kind of scenario. And of course, you have the risk that you really unanchor inflation if you have a runaway fiscal train. And so those are some of the thoughts that I think of, and I'll show you one more slide here, actually two more slides. Please. 17 is the World War II period, and we've unpacked that, you and I, Pamela, many times back during the COVID days, because there were some real parallels then. But during the World War II, obviously we had the war, we had a massive price shock because there were price controls, and then when those were lifted, prices went up, 20%. But you did not get lasting inflation out of that because we were still in the gold standard. And when the Fed was done monetizing the war debt, we went back to surpluses from deficits, and the money supply stabilized. And so that really was a transitory type of inflation. And then the 1950s were a very quiet period of low inflation, low interest rates, and a booming stock market. So it doesn't have to end well, but that maybe was one particular example of how it could end well as opposed to badly. When it ended badly, another example of that is the slide 18, and that was during the 1960s. And of course, the Fed was already independent then, but there was lots and lots of influence peddling by administrations from both sides of the aisle to get the Fed to do to help finance the deficit. So this chart is a little busy, but in the top you see the inflation rate. In the bottom you see budget deficits. In the blue, the Fed's policy relative to the natural rate in orange. So that shows you above is restrictive, below is accommodative. And then the gray shadings show periods of when the economy was either growing faster than its potential or growing slower. So we call that the output gap. And so that left box there on the left-hand side of the chart was the late 1960s into 70s. We call that the guns and butter era. And we had massive chronic budget deficits because there was a real emphasis on full employment. And the Fed was essentially way too accommodative, considering that the economy was running well above its potential. So you put those three things together and you're almost guaranteed to get a problem, right? You have loose monetary, loose fiscal, and an economy that's running hot. You're going to get inflation, which is exactly what we did. Not saying we're going to have an exact repeat of that, but the economy is growing beyond its capacity right now, or beyond its potential. Fiscal policy is loose, monetary policy is restrictive, but if that were to switch, like in 26 or 27, and you got those three things together, it could create an inflation problem down the road. So that's kind of how I think about unpacking this whole fiscal and monetary, back and forth.
That's absolutely fascinating. It's an interesting take on all this, and everyone really needs to sort of keep some of these pieces in mind. With that, it sounds like bonds could have a rough go. Obviously, if it's going to be inflationary, that could be a difficult moment. As we only have a couple of minutes left, I'm just wondering, though, on the equity side, there is a question coming in about, could increased momentum for U.S. equities also mean more momentum for international equities? There are questions about equities. Perhaps in that scenario, maybe we can just come back to what the equity market could see should all those things happen, and maybe have a tough go for bonds.
Yeah, so let's go to slide 1, actually. So this is the MSCI All Country World, and that's a good-looking chart. This is a global bull market right now. 72% of stocks around the world are in uptrends. The red line is the global money supply, and in this sense, right, if you have a fiscal boom in the U.S. and we might have fiscal boomlets in Europe and maybe in Canada, because everyone will have to spend more. That red line is going to go up, and the stock market will likely go with it. If the dollar is also going down, you could see capital reallocation to other parts of the world just to get that currency translation. So I think for equities, not only in the U.S. but around the world, it would be bullish until an inflation problem starts to affect valuations, but that wouldn't necessarily happen right away. So you can have kind of a melt-up scenario in this case. And again, you mentioned bonds. On the bond side, again, in Japan, the bond market is not really the bond market anymore. There are days when bonds don't even trade. In the U.S., I don't think it would go quite that far. Like the Fed wouldn't have to own every bond, every treasury. The banks would own some. Investors would own some as well. But if bond yields, let's say, are kept at 4 when they should be at 6, let's put it that way, and the Fed, let's say, owns half or more of outstanding treasuries, the bond market would still be functioning, but the term premium would be very low. And so it would reduce some of the value for bond investors because the real yield will probably be lower. But at the same time, it wouldn't cause tantrums the way the bond market has done over the past couple of years. So it will become a very boring asset class that just doesn't do very much. And again, I'm kind of projecting and speculating in all kinds of different ways, and who knows how this is going to turn out. But it's good to kind of think about these things because, again, these days in 2025, nothing is really too crazy to think about anymore. And so we need to be prepared.
Do you think that gold and Bitcoin and the way they've behaved have been partly thinking about a number of the things you just said there?
Yes, they have been seeing this coming from a mile away. And I think they would continue to see it coming. And so gold flipped from trading as the inverse of real rates, which it always did before 2022. And then real rates went up and gold doubled, which should not have happened. And so gold is trading on as the reverse of the dollar's reserve status, basically. And again, this notion of monetary inflation, big growth in the money supply. And I think Bitcoin is doing the same thing. So yes, they are very much part of it. But again, inflation could come up and the dollar could go down. And I think those are the two escape valves, as you will, right? You can control some markets, but you can't control every market at the same time. So then there's a release valve, and that probably is going to be currency and inflation.
Fascinating. Wow. You have given us so much to think about and to sort of chew on as we go through this week ahead. Jurrien Timmer, thank you for your presence. Thank you for your charts. Thanks for being here today.
Thanks for watching or listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on YouTube, LinkedIn, and Instagram. We'll end today's show with a short disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again. We'll see you next time.